is a deeply ingrained cultural belief that physical property is the only true form of wealth. You can touch it, you can paint it, and you can live in it. While equities are often viewed as nothing more than imaginary numbers on a screen. Because of that divide, most people pick their investment strategy based on social proof and dinner party conversations rather than actually mapping out the mathematical realities of a 20-year timeline. To see how this plays out, we can set up a 20-year stress test. We have two hypothetical investors of the exact same age, earning the exact same income, and both starting with exactly $50,000 in savings. The first investor takes path A and uses that $50,000 as a 20% down payment on a $250,000 rental property. They immediately secure a tenant whose rent covers the monthly mortgage. This introduces the concept of leverage, controlling a massive $400,000 asset by paying only a fraction of the upfront cost, makes the math look brilliant on a napkin. You are literally using a bank's money to build your net worth. The second investor takes path B. They drop their $50,000 into a total market index fund, set up an automatic contribution of $300 a month, and use zero leverage. Both of these investors walk away from the starting line completely convinced they made the smartest financial choice. But one of them is ignoring the invisible cost of their own time, and the other is severely underestimating the mathematical power of compounding zeros. On day one, the real estate investor is riding a psychological high. They hold physical keys in their hand, rent checks are hitting their bank account, and they have immediate social proof and a story to tell their friends. The stock investor's reality is entirely different. They log into a quiet brokerage account, see the balance move down a few dollars, maybe up a few dollars, and have absolutely nothing physical to point to from their car window. The stock market inherently feels passive and boring. There are no emergencies to manage and no visible progress, which can trick an investor into feeling like they aren't actively building any wealth at all. But the emotional validation you feel on day one of an investment is a terrible predictor of what your actual net wealth will be 2 decades later. Fast forward to year 3, and the real estate investor's on-paper profit is taking heavy hits from the relentless friction of property ownership. The bleed actually started at the closing table. Hidden front-loaded costs like stamp duty, property registration fees, and brokerage fees meant they paid significantly more than the sticker price just to acquire the asset. Then come the capital expenditures. Beyond the standard budget for annual maintenance, inevitable structural failures like replacing an aging roof or a dead HVAC system hit the checking account in massive, unavoidable chunks. And the math relies entirely on consistent rent. A property sitting empty for just 1 month between tenants completely wipes out a massive portion of the year's total cash flow. Meanwhile, the stock investor has spent 0 hours managing their money. Their portfolio is doing absolutely nothing but slowly drifting up and down, requiring 0 physical labor and 0 weekend phone calls. This path requires the property owner to assume a high-stress part-time job. While the eventual ROI covers this labor, the investor is effectively trading their nights and weekends for a yield that the stock investor receives for doing nothing. By year 10, we reach a critical crossover point where the underlying mechanics of both wealth engines fully reveal themselves. Real estate equity builds slowly through debt paydown and 3 to 4% annual appreciation. The middle gap is your wealth. The stock market relies on compound growth. Visual progress is slow, but right around year 10, the curve begins to aggressively bend upward. The stock investor has now reached the tipping point. The gains on their previous gains are generating more new wealth each year than their actual out-of-pocket cash contributions. Massive wealth creation demands a choice between 2 uncomfortable disciplines. You either manage the active physical friction of debt, or you endure the agonizing patience required for passive compounding. But neither path is guaranteed. real estate carries extreme concentration risk. You have hundreds of thousands of dollars trapped in a single, illiquid asset, entirely dependent on the economy of a single zip code. You also introduce a highly unpredictable human element. A single bad tenant who stops paying can trigger a lengthy eviction process, erasing an entire year's profit in legal fees and lost rent, and sometimes even putting the property itself at risk. The stock market has its own inherent flaw: brutal stomach-dropping volatility. A market crash can violently erase vast amounts of paper wealth in a matter of
And then
weeks,
he just walked
completely
right in. I
outside
couldn't
the
believe
investor's
it.
control.
No way, that is
The
absolutely
data shows that
classic
most
him.
retail
Classic
investors
behavior.
fall into a
To friendship.
behavioral trap
To
during these
friendship.
crashes. They panic, sell off their assets at the bottom of the dip, and lock in permanent losses at the absolute worst possible time. These inherent risks test an investor's resolve in different ways. Real estate creates a slow grind of friction and fatigue, while equities subject the owner to sudden, violent periods of panic. Fast forward to year 20, and this chart reveals the final tally. After 2 decades, both portfolios are sitting in the exact same net worth ballpark, hovering somewhere between $400,000 and $500,000. The real estate investor reached pure rental income only after surviving 20 years of property taxes, insurance, maintenance, and renovations. The stock tally, the original $50,000 plus steady deposits, exploded into a massive sum by the sheer force of compound interest. Real estate does hold a unique trump card in the form of legal tax shelters. Tools like depreciation and 1031 exchanges allow investors to defer capital gains and grow their portfolios completely tax-free, a trick stock investors simply do not have access to. The strict mathematical data doesn't declare a definitive winner here. Over a 20-year horizon, the true differentiator between these two paths is lifestyle, not yield. The real estate investor actively worked for their wealth, accepting high stress, illiquidity, and massive debt. The stock investor waited for theirs, accepting high volatility in exchange for total physical freedom. There is also a multiplier effect to consider. If the stock investor increased their monthly contribution by $200, their final wealth would have skyrocketed. For the real estate investor to scale up, they must take on another mortgage and double their workload. Committing 2 decades of your life to an investment based on a cultural myth is a significant risk. Success depends on aligning your portfolio with your actual tolerance for time, stress, and behavioral discipline.